Welcome to the Facts versus Feelings podcast. I'm your host, Ryan Detrick, and I'm joined by my co-host, Sonu Varghese.
Cutting through the noise each week with Ryan Detrick, Chief Market Strategist, and Sonu Varghese, VP Global Macro Strategist, taking out the boring and helping investors focus on what really matters. A quick note before we start the show. Investment advisory services offered through CWM LLC, an SEC registered investment advisor. Carson Partners, a division of CWM LLC, is a nationwide partnership of advisors.
And we are back. Episode 165 of Carson's Facts versus Feelings. Ryan and Sonu here. Sonu, we've got some some fun stuff to talk about. We're hearing this theme. Oh, there's a lot of stuff. We're in this theme coming up. We're calling this one is Reacceleration in the cards. And there's a lot of things that could mean. First things first, I was out in Arizona last week, like I mentioned, had a really nice time. It was nice to see the sun. We don't see the sun in Ohio. Do you see the sun in Chicago anymore? We don't have it. It's gone.
From
it's gone.
Like November through March, that's it. You have to decamp for the south somewhere, like the birds. Yes.
Mm-hmm. Yes. Well, that's we were just talking before we started. You and I both have a good amount of travel coming up. I know you go. Yeah. Don't you go? You going to Yuma? Are you going to Yuma, Arizona?
I'm going to Yuma in goodness, when is that?
January or hopefully
January? No, February. Okay, I'm going to Palm Springs. I have never been there. Then I'm driving to Yuma. I've never been there. So first, for me, you've been there the last couple of years, right?
So, I enjoy going to Yuma. We have great partners out there.
Shout out to our partners there.
Exactly. But that is I believe it's the second most sunny city, like in the world, not United States, like in the world. The sun is out like 363 days a year. I'm sure you can Google this or AI it to confirm it. Death Valley is like the hottest, and Yuma's like the second or third hottest in the United States.
Is Death Valley somewhere there, or no? Death Valley is on the Nevada, California side,
that's
on the way from Vegas to LA or something.
Right. But anyway, Yuma is always sunny, which is very nice. I can't make it this year, but you'll enjoy that.
Especially in February, Chicago, winter. I'm decamping. I'm taking my family with me to Palm Springs, by the way, not to Yuma, to Palm Springs. Hopefully it'll be nice and warm.
I bet it will be. Well, let's dive in because you love the data. The government took it away from you for a couple months, and there's a ton of data. And you sent like 19,000 charts to share on the YouTube channel today. But I think it's interesting what's happening. Markets rallying, Fed's coming up. We're going to talk about all that stuff. The yields are going higher. Last week, I guess it would have been Monday, so 2 Mondays ago, everyone looked up and realized, oh my goodness, the Japanese yields are going higher. The JGB is going higher. The 10-year yield in Japan is the highest it's been since 2007. We have Germany's yields going higher. And then last week, U.S. yields went higher. You can get into the weeds of it. But bonds, like good old-fashioned Barclays Ag, had like one of its worst weeks in months because yields are going higher in front of a Fed cut. Sonu, we could take this a bunch of ways, but how worried are you that yields around the globe, not just in the U.S., but around the globe, are starting to move higher?
Yeah, if yields go up, the usual thing is, we have an inflation problem.
Yeah,
right?
Exactly.
That's what. But this time, I think it's slightly different. I don't think, at least...
Wait. This time...
I said slightly different.
Okay, okay, good. Because Sir John Templeton is not famous for saying this time is slightly different. Sir John Templeton saying this time is different, the four most dangerous words. So Sonu's 5 least dangerous words, this time is slightly different, is what he's saying. All right, go ahead, Sonu. Go ahead in there.
So look, let's just talk about yields itself. The day before Thanksgiving, right, 26th of November.
Okay.
The 10-year yield was about 3.99%. As of yesterday, it was up close to 4.17. So that's a big increase. I mean, 4.17 is not unusual by itself, but it's risen quite fast, right? Over the span of 10 days or something like that. And a lot of it was holidays too, right? Yeah. Thanksgiving was off, then we had the weekend and yet another weekend in between. So yields have gone up really fast. Like I said, normally when yields go up, I'm like, there's an inflation problem. But if you look at, and this is where you can look at market expectations of inflation based on the difference between nominal yields and real yields measured by Treasury inflation protected securities. And I look at break-evens, where we call those break-evens, nominal minus real yields. That looks consistent with the Fed's target. It's not gone anywhere, which means nominal yields went up, but real yields also went up. And when real yields go up, I'm like, that is a growth story. And the irony is they're going to talk about, the labor market and stuff. We are talking about the Fed cutting rates, tomorrow. To be recording this on the 9th of December. The Fed meeting is tomorrow. They're talking about them cutting rates in the face of elevated inflation because there are labor market risks. The unemployment rate has been rising for a while now. And they're going to, try to cut off that tail risk of continuing increase in unemployment, right? But wait, the bond market is saying we think there's more growth coming, right? So there's some irony here. But at the same time, and this is where there's some, correlation, right? As you said, foreign bond yields, developed market bond yields are, sort of not quite apples to apples, but as apples to apples as it gets, is comparing US yields to German yields, as you did, and Japanese yields. Now, anytime Japanese yields go up, Ryan, what happens? Oh, it's a yen carry trade.
Oh, God. Yeah. And the Japanese Nikkei is doing okay in the midst of this. Because August of 24, that was not the case. August 24, remember, Japan was down like 13 or 14% in one day, that first Monday back in August of 24. So we're not having that yet.
No, and over the last 10 days, the S&P 500 has rebounded too.
Totally.
It's not down too bad, right? I mean, I know we'll talk about the Santa Claus rally and how the first 2 weeks of December tends to be sort of flattish, but we've done slightly better than that. I mean, never mind yesterday being Monday, December 8th. But look, Japanese 10-year yields are up to 1.95%. That is the highest level since 2007. It's up about 30 basis points, 0.3 percentage points quarter to date. German 10-year yields are also up to about 2.86. That was the highest we've seen since 2011. In Japan, look, I think it's coming on the back of the Japanese central bank saying, we think we're going to increase interest rates again.
And that's next week, right? They have a meeting next week, and they're supposed to hike. They're expected to hike.
Now, when they say hike, they're going from 0.25% to 0.5%.
Yeah, okay.
Keep that in perspective. We're at like close to 4% interest rates, and we're talking about cuts. But that's kind of pushing bond yields up in Japan. But why does everyone scream, oh, yen carry trade crisis? That's because, usually German bond yields are low. So people borrow, Japanese investors borrow, in Japanese yen, and they go invested in foreign assets, whether it's U.S. equities, but also U.S. treasuries. Now, if Japanese bond yields are going up, they're like, wait a minute, the cost of borrowing has gone up. So we're not going to do that carry trade anymore. So there's less demand for foreign assets. That's the story. I don't quite buy that all the time because usually the market is like, oh, a yen carry trade crisis. It's like, look at equity markets. They're doing fine.
Yeah, I was going to jump in there. I mean, hopefully after August 2024, believe me, it's a footnote. If you were there, that was really pretty scary. That Sunday night when we knew U.S. futures down 4%, the rest of the globe was crashing. We were pretty optimistic, but that was a rough night, and maybe you didn't sleep that well that night. I know I sure didn't. You probably didn't either, Sonu. But we got through it. So
I was on vacation, and you woke me up.
Good. You deserve that. You deserve that. You leave. And this is, by the way, you were on vacation recently, and the market sold off a lot that first Thursday, like just a bloodbath, and then we bounced. So this is the first time that this time is different. Sony went on vacation, and the market didn't outright
slightly
collapse.
different.
Slightly different.
Yeah.
Okay, so we're saying these higher yields aren't concerning. We're saying maybe it's saying there's higher growth coming. We got a lot of economic data, but you wrote an amazing piece, I guess it came out, we'll say today, for our Carson partners. We just call it Sonu's Daily Note. You really dug in. I read it twice. My head exploded.
But stream of consciousness.
I could tell. You were kind of bounced all over the place, but it was amazing. And
I was on a riff there.
And people say, how can I have access to it? Well, become a Carson partner. Become a Carson partner, join up on the right team, and you can get a lot of Sonu's conscious streams all the time. But you talked about bear steepeners and bull steepeners. I know this get a little wonky, but I think it's important. I think this is an important. So listen, we might blow some people's minds what we're talking about in the next 5 minutes, but I think this is important stuff. So to talk to me about how this is a bear steepener, meaning the longer end is going up faster than the shorter end versus a bull steepener, which is the opposite. Dig into that a little bit, what that means to just the average listener out there.
And when you're talking steepening and flattening, we're talking about the yield curve.
Yes.
So, and when you're talking about steepening, say, just as an example, take the difference between the 10-year yield and the 1-year yield, or even 10-year minus 2-year. Okay. Right. But if you look at the 10-year minus 1 year, it's up to about, what is it? I'm looking at my chart, about 56 basis points, 4.56 percentage points is the difference between the 10-year and the 1 year now. And the 10-year has risen, right? And when bond yields rise, prices go down. So that's why we call it a bearish steepening. But why is that happening? That's because 1-year yields have been sort of locked in by the fact that everyone's expecting rate cuts.
Exactly.
Right. Yeah. So the 1-year yield is essentially the average policy rate, Federal Reserve policy rate that markets expect over the 1 year. That's what the 1-year yield is, right? Okay. So it's going to be locked into market expectations for what the Fed is going to do. But the 10-year is rising. We just talked about that. And I think it's a growth story. But, that steepening is a bear steepening because bond prices are going down as yields rise. Now, we had a similar steepening in April and May of this year, and a little bit in August too. But that was a bull steepening. That's because yields are falling, right? And remember what happened in April and May after Liberation Day? Everyone thought, recession's here. In fact, there were people
it was
calling for a recession by summer, right? Or fall. Here we are in December. There's no sign of a recession. We'll talk about that. But anyway, because everyone is expecting a recession, people thought, the Fed's going to cut a lot, right? Now, the Fed has cut, including maybe tomorrow's, presumably, rate cut will be about 75 basis points this year on top of the 100 basis points that they did last year. So it's a lot of cuts. But the market is pricing more than that. They're pricing more than that. They're pricing more than that over the next 1 to 2 years. And 10-year yields are also going down because if you have a recession, that's going to be deflationary. Inflation's going to go down. But short-term yields went down more than long-term yields. So you still got the steepening effect. But because bond yields were going down, prices are going up. That's a bull steepening. Hope that all made sense.
And I guess the bottom line, the bear steepening we see now, is that historically in periods of better economic growth or worse economic growth or indifferent? When's that
generally? Yeah. Or if you have a lot of inflation.
Okay.
Right? If you have a lot of because then you'd expect, yields are going up. And maybe the story is, the Fed is too loose. That's why rates are not going up on the front end. Short-term rates are not going up, 1-year yields, for example. But then they're going to create an inflation problem on the back end. That's why yields go up. I don't think it's quite as simple as that.
Yeah.
I think the 10-year yield going up, yes, it reflects the fact that, rates will be on the lower side, on maybe slightly higher side over the next, 10 years. That's what the 10-year yield is. Average policy rate expectations over the next 10 years. There's uncertainty there too. But that's why you look at real yields, right? If real yields were not going up, that means break evens, nominal minus real yields would be going up. That's not happened. Break even inflation expectations are consistent with the Fed's target of 2%. So now then you have to say, I think this is a growth story.
Yeah. Okay. No, that's a theme we've talked a lot about, and we're going to dive more in. Shout out to Frank Capillari over Cap Thesis, our friend. Great technician. He had a chart this morning in his daily note. He said that 4.20%, so 420 on the 10 years, a very big level. We've had this big bounce. He said if we close up above 420 on like a weekly basis, then maybe those yields will keep going higher. But for now, the 10-year yields obviously bounced a lot, but it's not majorly concerning from a technical level just quite yet. I wanted to point that out.
And so on those technicals, you shared something with our friend Scott Brown, who you've worked with in the past. I mean, I thought he pointed out something that's interesting. Yes, the markets rallied over the last month. I think this breadth true. Yes, tech has been going up and down, but it's not come on the back of staples and utilities. In fact, utilities has been on the weaker side. Maybe that's telling you something about the AI picks and shovels trade. But financials have been doing well, right? Energy has been doing well, right? All of these other parts of the market that was struggling, say between July and September, October, that seems to be coming back right now.
Yeah, Lenny stole a little thunder there. So that we can put up the first chart,
sorry.
Drew. No, that's all right. We can put up the chart I had Drew on last week's action. And so it's the chart you shared in the morning call, where again, if you look at the sectors that led just last week, technologies. By the way, tech's up 11 days in a row, one of the longest streaks. Just put a pin in that. I'm going to go back to it in a second. But technology was leading. Energy was leading. I wrote it down.
That was after a big drop in November, right? I think tech was down 4.5%, something like that. And
tech's not back to all-time highs, but it is 11 days. Exactly. We had industrials leading, financials leading, comms leading. It was kind of the consumer discretionary. So you had the leaders leading, and then utilities, which I'll be honest, they had a rough go, and we've mentioned before we are slightly overweight utilities, like that group. Now, it hasn't been great for the models. Models done okay, but utilities were just hammered last week as yields moved higher. But you also saw staples, healthcare, which have been on fire. So more defensive things kind of lagged. The cyclical areas kind of taking that baton back as we potentially reaccelerate the theme of this podcast. Sonu, when you have an 11-day win streak on the on tech, what's your take on tech coming back here, reaccelerating to keep with the theme?
I mean, is it a bounce after a really bad November? I think there's some of that, right? It gives people an opportunity to come back into an area of the market where they may not have participated over, the first 10 months of the year, right? Like, oh, tech has gone down. Now is that time is to go into the AI play, right? I wonder if it's some of that. I'm just speculating. But that's what we do here.
Yeah, it could be. I mean, listen, it's a broad-based rally. I mean, I sound like a broken record. It's not just 7 stocks. Micro caps, literally on Friday, hit the all-time high. Look at transports, okay? Transports have gone nowhere for 4 years. They're now breaking out. I think it's that reacceleration theme. We're talking about commodities and a little bit being strong. You've got airlines have gone nowhere for a while, starting to turn up higher. I mean, these are like kind of cousins of the industrial sector. If the industrial sector is strong, that tends to be a pretty good economy. We think that's the case. According to our friend Subu Trade over, I guess on X, he shared this. But you look at 11-day win streaks on the XLK. That's the ETF for technology, not a recommendation on XLK. But in general, technology up 11 days in a row. So we had July 2009. February 2017, and right now, those are the only times we made it to 11 days in a row. 13 days actually back in 2017, and 12 days in July 2009. 1 year after the previous 11-day win streaks, according to our friend Subu Trade, in July 2009, up about 15% on technology. And a year after, February 17, up 31%. Yeah, I get it, small sample size. But the truth is, this strength we've seen in tech the last 11 days, the last couple times we saw it was not consistent with a blow-off top. And I don't think this is a blow-off top because, again, Frank Capillari did some data on this one, but it's 11-day win streak. But if you look at the gains, the 11 days, I mean, it's solid, don't get me wrong, but we've had a lot more bigger 11 days. And I kind of like that. It's kind of slow and steady. It's kind of condensed, not just some massive move. So just some thoughts there on technology and the strength. Let's talk about that broad market. So, what's your take again? We kind of hinted at it. Staples lagging. Staples relative to the S&P 500 last week closed like the lowest level they've ever closed at. I like to see that. Now, utility, you know what? Let's talk about utilities because we are overweight utilities. We've liked utilities. I'm looking at them like, this isn't great. We've got other parts that are working. Well, if all of our portfolios always worked, we'd probably have a real problem because no one's ever that good. It means you can always be wrong. So I'm okay seeing some, but utilities have not worked. What's your take on utilities here with yields going higher?
I think part of it is also that AI trade, right? Blowback from November when tech pulled back a lot. XLK, you mentioned XLK, the technology sector ETF from Spiders, that was down 4.5%, close to 5%, something like that. So utilities have become the pseudo tech play at the same, and we see that abroad too. China took a little bit of a hit, right?
Oh yeah.
EM took a little bit of a hit, and that's part of that AI play. Now, utility has, I mean, maybe a barbell within it is a way to think about it. It's got the defensive characteristics, the historically defensive characteristic, but now it's got the AI thing too. So it's, I think, sort of trying to figure its way out of this, but it's still upward. I don't know, 16, 17%, something like that year to date. Maybe the third best sector after technology and communication services. Comm is also sort of pseudo tech, right?
Yeah, if you look at the number of stocks in the utility sector above their 50-day moving average, there's like none. I mean, not surprising. It's got hit pretty hard. So it's kind of in washout territory. So maybe if utilities are a group you've been eyeballing, you wanted to get when it's kind of oversold. My goodness, parts of the, I mean, tech is not oversold. Tech is overbought. Utilities oversold. So which is unique.
That's a nice barbell there.
Yeah, for the last couple of years, those two have kind of traded together more often than not. But again, maybe some things are changing. Those are things I want to talk about. You want to get to the Fed and PCE data, or touch on something else from a market point of view before we do?
Yeah, let's on the point of broadening out, maybe we can put this chart up through of the Bloomberg Commodity Index. Speaking of things that are breaking out, you already mentioned energy.
Yeah, this is the black chart. We'll call it the black chart.
Yeah, the black chart. Yeah,
it's the black chart. Yeah,
the black chart with the white line. But the Bloomberg Commodity Index is up 13% since August. It's sort of, and over the last 2.5 years, all the way from like, let's say 2023, 2024, and into the first 8 months of 2025. So 2.5 years thereabouts. it's been sort of stuck in a range. Okay. Right now, this stuff is volatile. It's volatile within that range, but it's still been in the range. And now it looks like it's broken out.
It kind of looks like transports or microcaps. I know these aren't related, but I mean, we've seen certain groups that for years have gone nowhere, and now they're starting to. Right, tech's been way up here the whole time. Com service way up here the whole time. Now we're starting to see some other groups do well. Take it from there, Sonu. Just wanted to point out.
And the Bloomberg Commodity Index is going up. Usually, when commodities go up, what are you thinking? Oil prices are going up, but that's not been the case.
No.
Oil prices actually down over this period slightly, right? If you look at WTI or something, it's stuck, right? It may be slightly negative even over the last 4 months.
I saw gas in the U.S. under $3 for the first time, like I forget, a long time, like a long time. Yeah.
So this is everything else. You're talking about copper, aluminum, steel.
We were sharing some charts. Products. We were sharing some charts internally. Palladium. I mean, this is not a call for palladium, but I mean, there are a lot of these commodities that are just now starting to break out to new highs. You think about like gold way back in 2024 when it just started breaking out to new highs, how it's accelerated the last 2 years after that. Who knows if gold's going to do that, but I've seen some really cool charts shared online that looked at like equal weight commodities versus gold. The last 2 years, equal weight commodities gone dead sideways. That's because of oil, right? I mean, but gold's way up here. Now, historically, the last 2 decades, these have traded quite similar. So I think a big theme that I know we've been talking about this reflation theme. I think in 2026, if you drop it and it hits your foot and it hurts, you might want to own a little bit of that in your portfolio somewhere. We've been talking about this for a while, but I think that makes a lot of sense. What else we talk about?
It sort of underlines that everything you just mentioned, right? You get energy. We talked about the Bloomberg Commodity Index breaking out. You said transports, microcaps. I mean, if you had
Europe, the stock 600 on Friday closed at an all-time high. That's a lot of materials and a lot of financials. That's what Europe is, financials and materials. And they made a new all-time high on Friday.
Global bull market, which you've seen across this year, a global bull market, especially abroad. And now I think we're seeing a pickup in economic activity abroad too, right? Yeah. And maybe here in the U.S. as well. So we're going into 2026, the Fed's cutting rates. We're going to get more tax cuts, more refunds, things like that. Yeah, and the message of the market is maybe there's reacceleration, right? Yeah. Now, commodities going up, Brian, the other side of it is it can create an inflation problem.
Yes.
Right? That's the other side of the same coin.
Yeah.
Right. So, and we finally got PCE inflation data.
So let me jump in, just put a pin in that just for a second. We'll go to PCE next and the Fed. As an old school technician, market technician, I have my CMT diploma right there on October 14th, 2005. So I've had a CMT for 20 years. I'm looking at squiggly lines. I was actually the 499th. Like, oh man, almost to 500. But anyway, so shout out to the MTA. And the CMT Association. I guess it's not called MTA anymore. It's now called the CMT Association. That's how long I've been around. But anyway, where was I going with this? I totally lost my train of thought. I don't know.
Were you thinking about a chart? Technicals?
I don't know. I was, and I got all sidetracked, but I'm sure it was really smart, whatever I was about to say. Doesn't matter. Whatever. Let's go to I'll remember it. I promise I will. I'm getting older. Let's talk. So inflation. We had some inflation data last week. It was delayed. The Fed's favorite measure of inflation is the core PCE, they tell us. You have a bunch of charts, I know, for Drew. What'd you find when you looked at that inflation data?
Actually, and because, we've talked about consumer sentiment, there's a lot of consumer angst right now and about affordability and things like that. So I thought let's start with headline PCE inflation, right?
Okay.
And now this is September, so this is delayed data, but bear with us. So headline CPI headline PCE was up 0.27% month over month in September. What does that mean? You translate it to an annualized pace, that is 3.3%. That's not really soft. It gets to the fact that commodity prices are increasing. Over the last 3 months, it's run at 2.8% annualized pace.
So I'm going to jump in. I just remember what I was going to say. I knew I'd do it. I knew it. Sorry. As an old school technician following John Murphy, that's where I was going with this, and I went on my little sidetrack. You see late in economic cycles, leadership coming from energy, leadership coming from commodities, leadership coming from materials. So I don't think we're there yet. I don't think we're there.
Okay.
I mean, think about 2006, 2007, even first half of 2008 before it really got bad. Energy was doing great. Commodities were doing well. Materials was really leading.
And those are doing well for a couple of years there.
Yeah, for several years then. So, again, I want to be very clear. We're not bearish on the economy next year. We don't think there's going to be a recession. But if commodities do really well again next year, not just gold, but broad-based, I'll tell you, as we head into 2027, 2028, maybe we'll start to think about, what could break the camel's back, so to speak. It's crude oil. When crude at 145 in 2008, that broke the back. I get all the issues with leverage. I get all the issues with the housing market and all the crazy stuff going on. But that's what really broke the back of the consumer was crude oil too high, and then everything fell apart. So anyway, that's what I wanted to say. That means you're late cycle, but late cycle doesn't mean it's over. Let's be very, very clear.
And there's a reason why, as we get into the period where energy prices, commodity prices are rising, yes, the Fed focuses on core inflation, but the target is essentially headline inflation. It's inflation, period.
Yeah.
Right. They look at core inflation to see what the trend is, right, to take out what they call as the noise. But the target is actually headline inflation. Let's be clear, right? So if headline inflation is going up on the back of commodity prices, why is it late cycle? I think part of it is that the Fed is tightening. Actually, even in 2008, Ryan, the Fed wasn't ready to cut in May and June. This is before Lehman and all that. They did, but they were worried about inflation at the time. In fact, the ECB, Trichet was the ECB president at the time. They actually raised rates back then, which is in hindsight, what were they even thinking?
I mean, listen, I've made a ton of bad calls, but you can find Bernanke quotes where he's talking about subprime's not a problem. And what you're saying, they're early 2008 when it was clear something was kind of falling apart.
I think that was May, April or May when he said subprime, subprime's contained, something like that, subprime's contained, or
something like that. But guess not.
It's a tough job. Yeah.
Guess not. But, it is. Yeah.
But that gets to the fact that if commodity prices are rising, I look at, and right now inflation's more salient, right? Over the last decade, we can, goods prices are falling, services prices wasn't a problem. Now it's everything's elevated, and then you throw in rising oil prices, which we, by the way, haven't had for several months now.
Feels like crude's always $60 a barrel. I don't know. Just feel like it's always right around 60. Every time I look, right around 60. Yeah.
So commodity prices are breaking out without oil joining the party. Think of what happens if oil joins the party, right? Headline inflation's going up.
That's like a Dan Ives party. Those parties don't stop, so I've heard. I don't know. Yeah.
But look, food and energy prices, I think that's why are rising, and consumers are upset. Gasoline prices, yes, they're flat year over year, but they're up 15% annualized over the last 3 months. Gasoline prices. Yeah. Right. And that's because seasonal adjustments, things like that. Grocery prices up 3.3% annualized over the last 3 months. It's up about 2.5% year over year. Electricity prices, Ryan, they've come down a little bit over the last 3 months, but over the last year, 6.5% year over year.
Wow.
Right. So this stuff is, I think that's why consumers aren't happy. Right. So that's the inflation, the headline side of inflation. And remember, headline is sitting at 2.8% despite housing disinflation, right? Up until last year, we could say, inflation's elevated. That's because of housing. We can't really say that anymore because look at core inflation, right? Maybe, Drew, we can put this chart up of core inflation staying stubbornly high. Core inflation came up at 0.2% month over month.
Okay.
What does that mean on an annualized basis? 2.4%. Well, 2.4 is closer to 2 than 3. That's really positive. Over the last 12 months, it's sitting at 2.8%. But let's talk about September. Why did it come in, quote unquote, soft at 2.4%? Housing inflation, Ryan. Now, in PCE, housing is just about 17% of the basket. In CPI, it's 43% of the basket. So it still matters, but not as much as in CPI, right? So housing inflation was literally half of what we'd seen from January through August. Okay. It was 0.15% increase in September. It was 0.3% from January to August on average. Even 2018, 2019, it was close to 0.3%. So what we saw in September was really soft housing inflation. I think that's anomalous. We'll probably pick back a little bit. The other thing that was soft is, for whatever weird reason, we've seen a market rally from April through now. But PCE also measures something called portfolio management services, which is advisors and asset managers charging to manage portfolios. That was down 1% in September. That's obviously lagged. It's a lagged effect of what happened in March and April. That's going to rebound. So all this to say, despite housing inflation coming in really soft, despite portfolio management services inflation negative or in deflation, we still got core PCE at 2.4%. Right? That's still uncomfortably high. And part of it is core services inflation is running hot. Core services is running about 3.6% annualized over the last 3 months. Over the last 12 months, it was running 3.3%. For comparison, in 2018, 2019, it was 2.2%, right? And core services, this is services excluding housing, it makes up about 60% of core inflation. You're talking about healthcare, airfares, restaurants, hotels, pet services, right? Childcare, things like that, museums, concerts, all sorts of stuff. And inflation's stuck pretty high.
Well, I just want to make clear, that's why it's a two-man show. You said core PC was 2.4% year over year. It's 2.8, right? Isn't it
2.8? 2.4%. Yeah, annualized just in September.
Oh, okay, that's what we meant.
Just
Sorry.
September.
Okay, good. So good call out there. Good call out. But year over year, 2.8. So flirting with 3, stubbornly high is the theme we've talked a lot about. We did say in that recent CPI data that came out, I don't know, a month or two ago, we finally saw some cracks in some of the rent prices and shelter. But again, we know goods prices are higher because of tariffs. We know that. But services prices are high. So we'll just kind of put a pin in this. But the truth is inflation remains, not a problem, but I guess we're giving it the side eye look, right? Is that what we're thinking with inflation?
I think the Fed's giving it the side eye look. We think it's, I mean, look, we think it's a bigger problem than they're acknowledging. That doesn't mean we're expecting 4 or 5% inflation, to be clear.
Yeah, good point.
We're expecting, if the economy reaccelerates, if commodity prices go higher, I'll put it this way. I think inflation stays closer to 3% than gets to 2% next year.
Mm-hmm. I don't disagree, because I just look at the Bloomberg commodity index breaking out, and I just don't think that means you're going to have less inflation. Call me old-fashioned. Right. So the Fed is cutting. By the time people listen to this, the Fed's probably cut. We'll dive a lot more in when we actually know the exact data, but high level, what do you want to say about the Fed before we dive in next week a little bit more?
They're going to cut. Despite elevated inflation, we got a weak labor market. So hiring's weak. We just got JOLTS data finally. JOLTS data for October, Ryan.
And how happy are you, by the way? JOLTS data. There's few. Look at his smiling, right, on YouTube. I mean, this guy. The word JOLTS data, you think he just hit the lotto or something. I mean, it just sounds terrible to me. Let me sum it up. There were no hires. There were no layoffs. Nothing happened. That's the summary of the JOLTS. It's been that way for a year now. See, I didn't even look. That's like a no-look John Stockton pass to Carmelo, because I knew it was there.
You're taking the life out of this party here.
Sorry. No. Well, I mean, let's look. You want to combine the Fed? You want to finish the Fed, then go to the labor market? Because that's kind of...
So... The odds of a December cut right now, it's 88, 90%, something like that. Look, they're going to cut. And I think more cuts are coming in 2026. Last week, we talked about President Trump now nominating Kevin Hassett. Hassett's a favorite in prediction markets. 88% odds of him becoming the next Fed chair. Powell's term ends in May. So, and what's interesting is I just saw a report from...
Powell's taking that go away part of May real serious, isn't he? Like they're selling May go away. He's going away. Or is he going away? Is he going to stay, though? That's a whole other story. We don't even get into it. He could stay on the Fed, just not the main guy, but he's still part of the team.
That's going to hurt. If Hassett is there as the Fed chair, you kind of have Powell sitting around the table.
I don't know.
I'm judging you, right?
Yeah, I don't think I want my boss sticking around after he's supposed to leave. I don't know. No offense. Yeah.
Anyway, I just saw a tweet from Nick Timmeros at the Wall Street Journal.
Oh boy!
Pay attention to. No. This wasn't anything to do with tomorrow. What's happening with the Fed rate cut? Fed's December meeting had to do with Trump nominating a Fed chair. So in an interview, Trump basically said he was asked, do you want your Fed chair to reduce rates? And is that a litmus test for the new Fed chair? And you're not supposed to say this stuff out loud, right? You're supposed to say, they need to look at the data and forecast the economy and do what's right for the economy. Trump is like, of course it's a litmus test, right? They have to be reducing rates, right? Yeah. So anyway, speaking of Trump saying, I wanted to ask you this. So,
oh God, what are you going to ask me, Sonu?
No, it's on sports. So last week was a FIFA World Cup 2026 draw. Trump was on hand. He got the FIFA.
He got the award.
He got the award and all of that, the certificate and the medal. But it's his comments, right?
I think they gave him a Starbucks gift card too. I think I'm teasing. I don't know.
Hopefully it's a big one there, but or maybe hopefully it's a McDonald's one. I hear he likes that stuff.
Yeah, that's true.
So this is what he said. When you think about it, he's talking about soccer. When you think about it, and I'm quoting from here, it really shouldn't it really be called? I mean, this is football. There's no question about it. We have to come up with another name for the NFL stuff. It really doesn't make sense when you think about it. This is really football.
Yeah.
Speaking of stuff you're not supposed to say aloud as an American.
Yeah,
I thought that was funny.
Yeah, I mean, I can't disagree. You know, you should use your foot a little bit. And normal, I mean, it's funny because football is like, I'm going to say like a man sport. You're crushing into somebody and macho, mano a mano.
Yeah.
And so many times it comes down to the little scrawny kicker that screws up. I mean, it's just it's like,
no
really?
offense to any kickers.
Yeah, little scrawny kickers out there. Sorry, guys. Yeah, I don't know.
Yeah, Ryan's judging you all. But
I've had so many teams over the years. It would be so if we just had an adequate kicker half the time with the teams I root for. It'd be such a better life.
Maybe you should get Lionel Messi or Cristiano Ronaldo or something to do that. But it does seem to be a tough ball to kick. I don't even know if you call that thing, the football ball, right? That spherical thing, that elliptical thing, or whatever. So. Anyway, I thought
the old pigskin. The old pigskin.
The pigskin. Yeah. There you go.
Well, that's a good point. All right, where are we? You want to? I mean,
we were talking about the Fed.
Yeah, we've got 10 minutes. We've got about 10 more minutes. We've got 10 minutes.
So
anything else on the Fed?
Yeah, the Fed's going to cut mostly because the labor market doesn't look all that great. ADP payrolls came out last week.
Yeah. Well, here's what I was going to ask you. I'll set it up. I mean, ADP says the economy's not great. I'm sorry. The labor market's not great. The initial jobless claim said, wow, everything's fine. Square that circle, Sonu, comparing those two.
I think how I square it is basically what you said. There's been no hiring. There's no firing. That's it. Maybe you should use that as a tagline. But it's a low hiring, low firing economy. So ADP said payrolls fell. And I'm always skeptical about the actual numbers behind ADP. Right? And ADP measures private payrolls, just to be clear. So private payrolls fell 31,000 in November. Last 3 months, the average was negative 4,000.
Wait, I thought it was 32,000. I might have this.
30,
I swear it was 32. Look at that. Look at that. I barely even read it. I don't even look at the data. You're just making up numbers. That's why I'm here to fact check you.
What's 1,000 here?
Exactly.
And it's ADP.
Yeah, exactly. Anyway, 32.
So anyway, the April to November average, like the private payrolls increased by 19,000. Per month on average. Whereas you look at the prior 15 months, January 2024 through March of 2025, it was 143,000. Right? Now, like I said, don't pay attention too much to the exact numbers here. The big picture is hiring slow, right? And interestingly, Ryan, the big drop in November is due to small businesses. Hiring at large and mid-sized businesses actually looked okay. It kind of tells me maybe this is not AI. Because if it was AI, I think large businesses probably have a better handle on AI and processes related to AI. And I think, if anything, if you saw hiring slow down at large businesses, maybe you could attribute some of that to AI. At small business, I'm not sure.
Let me jump in. I mean, here's what I had written down, and probably literally straight from something you wrote. The last 3 months, small businesses lost 178,000 jobs, but large businesses added 143,000. So it's almost kind of like a wash, and small businesses are less than 50 employees. So again, when you have less than 50 employees, that's where the pain apparently is coming from.
Yeah, and then you get to the other side, but employers are not firing too many people. And now we talk about large employees, mid-sized firms, things like that. And that's why initial claims last week, Ryan, it fell to 191,000. That is really, really, really low. There's no question, like seasonal adjustments, whatever you look at, that is really low. And
it's like the lowest since 2022, I think.
Something
lowest
like that.
In years. Lowest in years.
Expectations were for 215,000, which even if it came at 215, it would have been low, but it came at 191,000, right? And that tells you layoffs are not running really hot. And we just got October JOLTS data as well. The layoff rate, the number of layoffs normalized by the number of people in the workforce, that's 1.2%. Right, it increased from 1.1% September, but that's also really low. Before the pandemic, when we had a tight labor market in 2019, layoffs were running at a rate of 1.2, 1.3%. So, low firing, low hiring, but I think that's why, the Fed's going to cut. We have slow payroll growth. The breadth of payrolls is not great. Most of the jobs, at least looking at, what industries it's being created in, most of those jobs are being created in the healthcare sector, so the breadth is not great. And then we have a rising unemployment rate. It's gone up to 4.44%, 0.01 percentage points off of being rounded to 4.5. And that's essentially why the Fed's likely to continue cutting rates.
Well said. If you're enjoying the show today, hit that subscribe button and drop a comment. It's the easiest way to help us grow. Those algorithms love comments, and I can't lead the witness. We'll take negative comments. We'll take positive comments. We don't care. We just want comments. Although leave the negative comments towards Sonu and the positive toward me, if you can please do that. I will say, Sonu, the 191, the initial jobless claims 191, it felt a little low. I mean, it's like, okay, it was Thanksgiving week. And then I saw our friends out in California. They have a lot of sun, but apparently there's some wonkiness. We use the word wonky when we don't understand it. Some wonky things going on in California. Remember, we had some of that with New York. New York teachers, apparently every single June, you see a big spike in initial jobless claims in New York because of the teachers. We saw something in Texas, and then it kind of evens out. I mean, it's probably going to pop back. Did you have a chance to look at that? Was there something wonky out there in California last week or 2 weeks ago, I guess?
I think part of it was Thanksgiving came later in the year.
Okay.
And so when you do seasonal adjustments also, that throws everything off.
Yeah.
Right? And you like, obviously in Thanksgiving weeks, you have only 4 days, but you're seasonally adjusting to periods at 5 days. So, because that... but even if you look at non-seasonally adjusted claims, and that's what I usually look at, for the past several years, it probably made more sense to look at non-seasonally adjusted claims. That's running below where we were, below the same week in 2023, below the same week in 2024, and even 2018, 2019.
Yeah, there you go. Yeah, I'm just playing devil's advocate to a degree. Continuing claims, which had been going higher, that had a pretty good sized drop and has stopped going higher, at least as of now. So, again, it's been, if you haven't really been getting laid off as much, but if you had been, it's maybe a little harder to get a job by continuing claims, but that's improving. The bottom line, I guess there's some cracks in the labor market. I feel like a broker record, we've been saying there are cracks in the labor market. Massive issues, maybe not massive yet, and that's why the Fed should be cutting, fully aware of the issues with inflation, like we broke down.
And if anything, the good news, the glass half full look, I mean, other than layoffs being low, is that hiring's not getting worse.
That's a good name for a podcast, the glass half full. I like
glass half full.
I mean, like, just point out, or maybe maybe we should have like a quick YouTube video where we just, the glass half full. We just share
that's the next
positive. Remember during COVID, everything was shut down. I can't pronounce his name. I'll just call him Jim from The Office. I forget his John. Jim from The Office. He literally had like a podcast. It was like just positive things. That's all it was. It was like, let's just share, because there was nothing positive back then, or at least very few things, and it really took off. So I like that, the glass half full. Anyway, there we go. But,
the glass half full, because like you mentioned continuing claims, that tells you that unemployed workers are having a slightly harder time finding a job because hiring's weak, but that's not gotten worse over the last few months.
Good point.
In summer it did get worse. Like hiring, I think they did take a step lower, but it's not gotten worse. Like I said, that's a glass half full look here.
Okay, I love it. We're getting near the end. We'll talk. Anything else you want to talk about on that front?
Chart. One of your favorite charts, which is disposable income and employee compensation, comparing that to PC inflation.
Let's go there. Then we'll talk a little bit about December seasonality and probably wrap it up. So we can put that chart on the screen right now, Drew. About my favorite. I don't know if my favorite. But it's definitely one of them.
One of them.
Incomes are still strong. What do we find in there?
This is a chart showing disposable income and compensation growth staying ahead of elevated inflation. Remember in Q2, we were talking about, all income growth is slowed. And that gets to weak hiring too. Because what is aggregate income growth? It's the number of people getting employed.
We're also promised a recession in Q2. So like if you're a company, you're looking around, you're like, maybe I'm not going to hire because they told me on TV there's a recession. So
But things have bounced back in Q3. Disposable income.
They've reaccelerated, Sonu. That's the word of the day. They've reaccelerated.
Yes. Yeah. Disposable income up 4.6% annualized over the last 3 months, right? And now when I say last 3 months, it's actually July, August, September, because that's what we have the data for. Employee compensation. This is compensation growth across all workers in the economy. That was up 5.3% annualized pace. 2023, 2024 was really hot. It was 5.9%, but 5.3% is nothing to sneeze at. And then you think, okay, that's nominal. What about inflation? Isn't inflation running high? Yes. Over the last 3 months, PC inflation is running 2.8%. That's the headline PCE index, right? You take the difference. Real income growth is running about 2%, maybe, slightly higher, something like that. That's positive for the economy. That's positive for consumption. And we have nothing close to a recession right now.
Yeah. No, well said.
There's no two ways, I mean, it's yet to get Q3 GDP data, but I think that will be pretty hot.
You shared some great charts. I'm going by memory here, but when you don't have a recession during the year, only 5% of the time is the stock market down 10% for the year, right? 68% of the time. So we're just going to round up everybody. 7 out of 10 times you're up at least double digits on the year when you don't have a recession. So some of these reacceleration themes we're talking about, believe me, there's a long way to go. We get it. But if this is, let's just say for a second, the economy surprised to the upside. Earnings are expected to be up, 13, 14% next year. Maybe they're up a little bit more, right? Maybe inflation is a little bit higher than expected, but we still have this dovish Fed. We still have a global bull market. I've talked a lot before. One of the best indicators we have for the economy is the stock market. When the Dow Jones average hits a new high, the odds of a recession the next 12 months are extremely strong. Yeah, a 100-year pandemic can do it, maybe a couple other times in 125 years existence. But the truth is, you simply don't move right into a recession when you're hitting all-time highs, and we're hitting all-time highs around the globe.
And transports, things like that too, right?
Yeah, I mean, yeah. If airlines are hitting all-time highs, that's probably a sign that the economy is not that bad, And I know the K-shaped economy. We've talked a lot about that, but the reality is, again, things are pretty half glass full, glass half full.
I think last week we missed the whole discourse, if that's a word for it, on like how $140,000 is like the new poverty line, and it was like, I should say without naming names, it was like a noted bear who was like bearish on the stock market for a while. He was like, he wrote this piece which went viral, I should say. Everyone covered it, even like the big publications. I think I don't know if the Wall Street Journal, maybe the Washington Post or someone had a piece on like how $140,000 is the new poverty line. I was like, wait, come on, like. Speaking of glass half empty takes.
Well, no, it is. I didn't see it because I was in.
Lucky you!
I was in Arizona, just eating and drinking and laying around for a couple of days for my wife's birthday. All right, so the last chart we'll share is the Santa Claus rally. Drew, you can throw that one up. Just be aware. I think we talked about this last week, but let's do it again. The first half of December historically is kind of choppy. That's kind of where we are. The time we're doing this, we're like exactly flat for the month of December. You tend to have Santa Claus come later in the year when things are strong. And then some other, the other ones I want to touch on. So we're in year 1 of a presidential cycle. And I think I did mention this last week, but it's good stuff. So I'm going to do it again. In year 1, Sonu, the presidential cycle, December has been higher 9 of the last 10 times. I think it was 2005 was negative, but just by like 0.1% or 0.2%, so just barely. And then if you go back to World War II, when you're up at least 5% going into the last month of the year, so a good year, solid year going into the last month of the year, up 5% or more. December's been higher 12 out of 12 times, again, in the first year of a presidential cycle. So just some things to think about, that why we think maybe you chop around the Fed, this and that, but once you kind of digest it and get through it, some of these reacceleration themes and just regular good old-fashioned seasonals could take place, and we think stocks will probably be up again in December, which would be the 8th consecutive higher month for the S&P 500. Eventually, it's going to be down. Honest to goodness, I wish it would have been negative in November. And I know we baited by like 0.1%. Yeah. I wish it just would have been negative so we could stop talking about it, because but it happened.
You had a chart showing, like, I think it was 16 periods where we had at least a 7-month win streak, but only 10 out of the 16 went on for longer streaks than 7.
Yeah, exactly. 16 times up 7 months in a row. The next month was higher, 10 of them. So that's
remember
not that bad. There you go.
Yeah.
And like 6 months later, S&P's higher 14 out of those 16 times. Drew, actually, we'll put that chart up now. Drew, I'll send you this chart later, but on 7-month win streaks, going by memory here, everyone, so it'll be on the YouTube channel. But you have really strong returns 1, 3, 6 months later after a 7-month win streak. Yes, going out a full year, you're about average returns. Okay, that's fine. You had a heck of a run. But the near-term reacceleration, to play the theme we've had, is real. And 7-month win streaks are not a reason by themselves to turn bearish, even though so many do. All right,
I have one last question.
Last thing, what do you want to do?
Which actually a question for you, which I imagine you'll get over the next week or two from the media. What could derail the Santa Claus rally?
I think the Fed.
Yeah, that's what I had in my mind.
It's kind of cliche to say, but I mean, for those of us that were there,
I was wondering if you would say that too, but I didn't want to put
2018 is still. I'll forever be scarred by that one. If you were there, you were there. Where the Fed didn't give the market what it wanted, had a near bear market in like a week and a half, bottom on Christmas Eve with just a obliteration day on Christmas Eve, and then it rallied, but it was not anything that was very fun. So I think that's kind of the one thing. Maybe the Fed, will they be a hawkish cut? Will it be a dovish cut?
Sure.
I mean, we'll talk about all that next week, but that'd be the one thing, I guess, that's out there that kind of worries me. Because again, we're not seeing credit spreads blow out. We're not seeing leadership from staples. We're seeing high beta relative to low vol hitting like the highest level it's ever hit. I mean, these are every market virtually around the globe is hitting new highs. You've got transports up. You've got European banks hitting all-time highs. You've got large cap banks in the U.S. hitting all-time highs. Regional banks are starting to do a little bit better. I mean, these are areas that tend to suggest, it's a risk on market, and the upside, or the risk is to the upside. I'll never forget. I think it was I guess I forget because I don't remember the exact date, but it was like in the middle of 2023. I was on CNBC and they said, "What's one of the biggest risks?" And I was like, I remember that. You never know. You're on the hot seat. You never know what you go. I never know what I'm going to say. Just wing it. I'm like, biggest risk is too many people are bearish. I didn't say listen to your network. I didn't want to go that far. But I mean, I said, this everybody's bearish. The biggest risk is market's going to keep going higher. And that's
and you're going to miss out.
That camp. Then you're going to miss out. Exactly. You're going to miss out, and that's kind of what happened to a lot of people. All right. Well, listen. So anyway, I think we've gone plenty long. All right. Again, on YouTube, you can give us comments. We love that stuff. So if you want to help us out, give the comment, give the like, give the follow, do all that stuff. We really, truly appreciate it. Thanks to Drew, our new producer, helping us over at Pod Pony. We're so excited to work with Pod Pony. This is going to be a great. We're going to keep working this podcast and taking it to the next level. And we're so excited about what we do in 2026. And thank you to all the listeners out there. On Friday, we have a special guest. Not going to say who. We always tease this stuff. I'll just say Boston. That's all I'm going to say. Okay. If you kind of
that'll be the Christmas Eve episode.
Christmas Eve. It'll come out. We just do these 52 weeks a year. We just do them early anymore. We love doing them. We know people like them. So every Wednesday, you're going to get one from us. We're not stopping, but we're doing one early with a true legend of the industry, Boston. That's all I'm going to say.
Christmas Eve, listen to it with your families.
Yeah, there you go. Exactly. So huddle around some hot cocoa and maybe a Boston lager of some sort. I don't know. But next week we'll do a regular one where we definitely dissect what the Fed had to say. And our outlook, it is like done. I mean, on our end, it's done. I mean, hopefully first, second week of January. Can't give a exact date yet. Don't want to promise and underdeliver, or over-promise, underdeliver. I've made a career doing the exact opposite, so I'm not going to start now. Not going to change doing that now. But anyway, our outlook, it's great. You're going to love it. We're proud of it, and hopefully you're going to like it as much as we.
You got all the charts in. It's like 35 charts, 35 charts, something like
Shocking.
that.
Anyone listen to you and I and Barry on our team and Grant on our team. Of course, we had a lot of charts, but hey, you know what? Charts tell a good story. Everyone, thank you so much for listening. Again, this is episode 165 of Facts versus Feelings. Is reacceleration in the cards? I think we hinted at. We think there's some reacceleration coming in a couple different places. See everybody next week. Enjoy the Fed day. Enjoy the holidays. Enjoy some snow, some cold weather, and we'll see you next week. Take care, everybody.
Information provided on Facts versus Feelings with Sonu Varghese and Ryan Detrick are for general information only and are not intended to provide specific advice or recommendations for any individual. The statements and opinions of show guests may not be reflective of CWM, LLC, or its affiliates. Past performance is no guarantee of future results. All indices are unmanaged and may not be invested in directly. Investing involves risk, including possible loss of principal. No strategy assures success or protects against loss. To determine what may be appropriate for you, consult with your attorney, accountant, financial or tax advisor prior to investing. Guests on Facts versus Feelings are not affiliated with CWM, LLC.